Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here. Today will be Tuesday, the 23rd of July, 2024. So before we jump straight into our Daily Dose of Market Insights, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, this will be the key gist of our usual daily dose of market insights. Let's kickstart with what has taken shape overnight in terms of news flow, economic data, if there's any, and as well as how does it impact the various performance of the major cross asset classes ranging from the stock market, the FX pair, the dollar FX pair, and as well as potentially if there could be any cross play that is in play in terms of FX market, and as well as the two key commodities, gold and West Texas crude oil. So let's have a quick we call it recap of what has taken shape yesterday. So as we know that at the start of this week event is at the start of this week, the key event over here was a US presidential election where Biden, under the urging of the senior Democrat leadership, has decided to step aside and hand over the him to the current Vice President Kamala Harris to be the Democrat presidential candidate for this upcoming November US presidential election to face off against Trump. So the big question yesterday I posed for you guys in the daily dose is, would there be a challenge coming up from the Democrat camp to actually challenge Biden endorsement for Kamala Harris? So the story over here is at this point in time, more or less, I would say that close to 95% chance that Harris has enough delegates to clinch nomination for president. That means she'll be the top choice of the Democrat candidate to face off against Trump this November, ahead of the 6 and 7 August Democrat convention, like what the Republican convention that was held on last Friday, where the Republican officially nominate Trump as their choice of presidential nominee or the candidate. So right now over here is that based on various media reports, most prominent Democrats actually threw in their weight or support for Kamala Harris to be their choice of Democrat presidential nominee. So at this point, no prominent Democrat that has actually wants to actually challenge her current endorsement. So more or less, I would say 95% chance she'll be facing off with Trump. All right, but for sure, the only confirmation that we will get is on the 6 or 7 August Democrat convention, where the Democrat camp will officially endorse their choice of Democrat presidential nominee to face off against Trump. So the most important thing over here is how does the market react? But before the market reaction over here is that let's have a quick look at the betting odds. So the betting odds tell us the betting market view of the presidential election result coming this November. So this particular site, you can just Google Real Clear Politics. They just that 2024 US president, you're able to get this site as well. So over here, what I'm going to share with you, maybe just put it 3 months. Okay, much clearer, right? All right. So this is actually a quick recap. It's actually a website that compile the average betting odds of the key betting sites that actually market make or book make the ongoing US presidential betting market for this November election. So you have the various key betting markets like bet online, Betfair, BetWin. Then you have the Predicted, which is the most popular one over here. So, but I want to share with you what's interesting over here is that for Trump, it continues to actually hover downwards. All right. So based on the latest data as of as of yesterday, Trump odds is at 58.7%. But if you look at Kamala Harris, her odds has now risen pretty remarkably since 2 weeks ago. Now hovering at 32.3%, and the gap is getting narrower between the Democrats and the Republican. All right, so the Democrat for sure, 95% chance will be Kamala Harris at this point in time, because of most of the prominent Democrats has really more or less endorsed her, except that it was not made officially only next month in the Democrat convention. For the Republican, for sure, is Trump, because they already more or less endorsed, they already 100% endorsed him in last Friday Republican convention. But you realize that the gap itself between the Democrat and the Republican now is getting narrower. So what it means that the market is now viewing Trump trade, or the policy of implementing Trumponomics, has lesser chance of passage, given that right now Kamala Harris is the choice of the Democrat presidential nominee, and her being a better put it a better candidate as compared to Biden, because the Republican could not use the health issue anymore to actually debate on the current health status of Biden, whether he's fit for office or not. Kamala Harris is younger, and do not forget, Kamala Harris, whatever policy that Biden emphasized for the next 5 to 6 years in the US economy still remains the same. I believe that Kamala Harris shouldn't be much changes. That means, i.e., we start to see tariffs that is being targeted to China, but at a lesser scale compared to Trump, and not so much of a tax cuts over here. Okay, so Biden don't actually promote significant tax cuts, so that could actually also potentially do not have a negative impact on much. I say that do not have a much more drastic negative impact on the U.S. budget deficits. That means, i.e., without the passage of Trumponomics, there will be a lesser risk of U.S. Treasury longer-term yields moving upwards or on an upwards trajectory, which eventually lead to a much more muted dollar strength scenario, at least in the near term. But do not forget, once the U.S. tariffs start to hit in against China, where Biden is also heavily promoting as well, especially he has a different tiering system, that means different tariff percentage or quantum according to different kind of product or services that is being coming out from China. So the harder hit was actually EV, and the EV products from China has a higher tariffs that he actually advocated. So net overall, in from a longer term perspective, right, if the tariffs is being hit in the later part of the next administration, be it Trump or be it Harris at this point in time, it could be still a dollar positive, but market yesterday view it as a dollar negative story or a dollar muted strength story. And what we could see over here is that, given that Trumponomics, again, the passage of Trumponomics has been greatly reduced, not say reduced, I would say that have been slightly reduced right now. The rotation play into those stocks that are heavily weighted, that has a preference choice by Trump, seems to be getting lesser right now in terms of their performance. That means, like, banks who benefited from a higher US Treasury yield, and you have energy, which also being one of the pet, we call it project of Trump, to actually allow US to be the major energy exporter again. That was one of his key policy. And that particular, those trades, that means, i.e., bullish on financials, bullish on cyclicals, bullish on industrial stocks, energy stocks, those trade has started to actually tone down or being profited, and we see a rotation back into the mega cap tech stocks again yesterday. So what we could see, if you look at the performance in terms of the US stock market over here, we see a very strong, we call it a catch-up recovery, intraday recovery play on the SPX and the Nasdaq 100, after in the previous two sessions they actually suffered much more significant losses due to the rotation play into the value-oriented stocks itself, where the S&P and the Nasdaq 100 are not heavily weighted. They are more heavily weighted on the mega cap technology stocks. So both of them up 1%. The Nasdaq 100 is the top performer, up 1.5%. And the Dow Jones Industrial Average being heavily weighted to the value and cyclical stocks, they're actually up by only 0.3%. But surprisingly, the Russell 2000 is still holding pretty much firm, up by 1.66%. So I believe that this Russell 2000 also could be the upcoming dovish US Federal Reserve change of stance that is going to take shape in September, that is also giving a bit of a tailwind to the Russell 2000 outperformance yesterday, because given the fact that the Russell 2000 company are mostly heavily we call it geared in their balance sheet to actually maintain their business operation, and they borrowed more in short term rather than long term due to their lower credit standing. And given that the Fed is about to more or less turn to a dovish stance in the upcoming September meeting, and perhaps next week, which is the July meeting, they will start giving such guidance. So that actually also potentially could be a beneficiary to the Russell 2000 because of the lower 10-year US Treasury yield, like the 2-year, will start to continue to inch downward. So in fact, yesterday there was some signs of softness coming back into the 2-year Treasury yield market. Later on I share with you all. So this is the performance of the US stock market yesterday. So if you look at the heat map of the S&P 500, for sure, what we could see a slew of green in the mega cap technology stocks. So all the mega cap technology stocks actually closed in the green, with the acceptance of Apple with a slight loss of negative 0.16%, and the ever leading Nvidia managed to fight back with a gain of 4.8%. So later I'll flash the chart of Nvidia. Why? Because Nvidia has a significant intermarket relation or correlation with the, especially on the Nasdaq 100, when I do the short-term technical outlook on the Nasdaq 100 thereafter. All right, so these are the key fundamental news that I want to share with you all that taken shape yesterday. So in terms of other economic data, yesterday was a quiet session in the European session and the US session, so no key data releases on these two continents yesterday. So one thing I want to share right now over here is the performance of the FX market. So now let's do a bit of intermarket analysis on the FX market. So starting with the FX market over here. So if you look at the 5-day rolling performance of the FX market itself, so what you could see over here is that this is the 5-day rolling performance of the dollar against the other major currency. So what we could see over here is that the dollar is getting very, very strong, continue to be strong against the Aussie and the Kiwi, and also against the CAD, the dollar, Canada dollar, but kind of sideways against the sterling, the euro, the Sing, the Chinese yuan. And interestingly, at the bottom, the dollar is weak against the Swiss franc and especially against the Japanese yen itself. So one of the reasons over here why this particular yen is, the dollar yen is so weak over here is there could be also fundamental reasons at this point in time that number one, the next week you will have the Bank of Japan. So next week, Bank of Japan very likely no interest rate hike. Okay, no interest rate hike, because they are still data dependent. They want to see more data coming into the Japan's economy before deciding to actually hike the next step. Okay, after hiking the first time since 17 years in the March meeting. But right now there's an increased speculation that in this coming July, end of July, that means next week, BOJ, Bank of Japan meeting, they will actually use it as a signal to signal the market that they are about to actually turn much more hawkish in terms of their monetary policy. That means first step is to potentially reduce the amount of JGB purchase that they can purchase every month to actually smooth out the market operation. So that could actually also lead to normalization and allow market to much more at a free hand to dictate the movement of JGB yields. All right, and do not forget over here is that if we were to look at this particular chart itself, which is I tend to actually do the spread. Okay, give me sorry. Okay, 1 second. Let me open up the chart again. Okay, so this is a 5-day rolling performance. Okay, so let me open up another chart which tell us the spread of the US Treasury yield against the JGB yield. Okay, this chart over here. Okay, let it load for a while. Okay, it should be loading. Yeah, yes. So if you look at the 10-year US Treasury yield minus the 10-year JGB yield, it slowly starts to inch downwards, all right? After the breakage of the previous, the breakdown of the previous 28 December and the 2nd of February medium-term swing low. Okay, so it continues to print a series of lower low over here, lower low, lower high. That means indicating to us, right? Previously, the US 10-year Treasury yield premium at April, it was at 3 point, this level here, it was at 3.85%. And the yield premium has now shrunk to 3.17%. That means, i.e., it tells us right now over here is that the carry of going short yen long dollar is no longer as attractive as before versus April. This on the 10-year, using the 10-year. So if you look at the shorter term tenure, the 2-year US Treasury minus the 2-year JGB yield, so that's more likely related to a monetary policy of the various country, more as a proxy. It's right now over here also testing the medium-term swing low of the 1st of Jan, and looking to actually dangerously breaking below it as well. But prior to that, it continues to actually trade a series of lower high. Okay, since the April high of this 4.78 over here, right, at 4.78% or 4.77%. So the yield premium between the 2-year Treasury yield and the 2-year JGB yield has also started to shrunk from 4.77% to 4.18% now. All right, so this tells us that the positive carry of using yen as a funding currency and to invest in other high yield asset class like the US Treasury yield is not as attractive as before compared to 3 or 4 months back. So that actually also supports that yesterday's this short-term dollar yen lack of strength of pushing up above the 137 short-term resistance, which we highlighted yesterday. And what's interesting over here is that if we were to get into the insights of the yen crosses itself, that means I'm not only looking at the major currency against the yen, is getting much more obvious over here. Okay, so now let me now string this chart and okay, where was it? Okay, yeah, over here. Okay, let me put this chart for you guys to see. Okay, so this is the G10 yen crosses, means the highly liquid yen crosses, 1 month rolling performance as of today. All right, so since 11th of July, we see the yen crosses has been inching very clearly downwards. That means what I did over here is that I plot sterling yen, euro yen, Swiss yen, Aussie yen, dollar yen, cat yen, SEK yen, New Zealand Kiwi yen, and Norwegian krone yen. So what we could see over here is that all this major currency pair is actually weakening against the Japanese yen, which is a variable currency. So net, we start to see in the FX market, there's some form of yen strength coming back into the picture, not even against the dollar, but against other major trading currency as well, such as the sterling, the euro, the Aussie, the Kiwi, dollar cat, and even the Norwegian krone, the Sweden krone, and the Norwegian currency as well. So what we could see over here is we got to respect this short-term price action movement of this ongoing yen strength revival, at least from a short-term perspective, which I'll later share with you all what are the key levels to look out for today on the dollar yen intraday technical outlook. All right, so this is the FX intermarket dynamics on the FX market that is taking shape right now. And the next one I will share with you all is the intermarket dynamics on the major US stock indices. Why? Because we start to see in the social media right now that after that 1 week, last week very weak, I would say that not so weak, I'll put over the lackluster performance of the 2 key major US stock indices, the S&P 500 and the Nasdaq 100. we see a bit of fear coming back to the market, kind of stating that is this the start of a potential 20% corrective move? Then what we could do over here is that we will look at the market breadth of these two index. That means dissecting how this individual component of the index is playing out. So if you look at the market breadth, which I tend to look at the percentage of stocks holding above both the 50-day and the 20-day moving average from it, because this gives us a medium-term perspective of the outlook of these major stock indices. Let's start with the Nasdaq 100. Yeah, Nasdaq 100 was last week, they actually plummeted, not say that our chart, maybe I don't know, they actually declined the most among the major US indices. Why? Because they are heavily weighted towards the mega cap technology stocks, and also due to that ongoing rotation play, given that the chance that Trump himself may have a high chance of winning the US presidency because of Biden's very weak performance. And right now, Biden is really out of the picture. We have a better, stronger contender from the Democrat camp. The Trumponomics passage has been reduced, and what we see over here is that we see bidders starts to actually come in to scoop up some of the last week beaten down Nasdaq 100 component stocks. How do we see that? If you look at the percentage of Nasdaq 100 stocks above the 20-day moving average, yesterday they actually managed to improve back to above the 50% mark. So on Friday, it was at 47%, it actually went down to 50%, and right now on end of Monday, it managed to go up to 50% and close at 54%, which is a pretty healthy number. All right, and the one that is holding above the 50-day MA, despite last week lackluster performance, on last Friday, we have still 54%. That means still above 50% mark. That 54% of the Nasdaq 100 component stocks are still trading above their 50-day moving average. And yesterday, it actually improved much more significantly than holding above the 20-day MA, which is at it improved by close to 10 percentage point to 62.7%. Okay, there was a big, much more significant uptick over here. And the broader, we call it S&P 500 index, continue to hover healthily above the 60% mark for both the 20-day MA, for the percentage of stocks holding above their 20-day MA, and percentage of component stocks of the S&P 500 holding above their 50-day MA. All right, so what we could see over here yesterday, you also see an improvement. 75% of the stocks are still trading above their 20-day moving average. And also we have 68.69%, okay, on average 69% of S&P's component stocks, S&P 500 component stocks that are trading above their respective 50-day moving average. So net overall, what we could see here is that the market breadth has started to actually also be in a healthy, we call it ranges, and plus it starts to improve yesterday after its prior week of weakness that was being translated on the movement on the S&P 500 and the Nasdaq 100. But so net overall, the chances of shaping the so-called potential 20% corrective decline over here, in my own opinion, it seems to be have a lower odds, or it's a slim chance right now. Why? Because the market breadth is still continues to actually support this ongoing medium-term uptrend phase of the Nasdaq 100 and the S&P 500. Yes, in intraday, there could be a lot of volatility. That means we could start to see this 1% or 2% decline, but the start of that 20% corrective decline sequence seems to be has a lower odds at this juncture, in my own opinion, based on the market breadth analysis which I shared with you all a few seconds ago. All right, so now that actually sum up the intermarket dynamics that I'll share with you both on the FX and the major US stock indices. So with that, let us now quickly jump straight into the short-term intraday technical outlook, starting with the FX market first. So before that, let me expand my screen so that you all can see the key levels much more clearer. Right, so now let us start with the FX market. Let me call up the chart of the euro dollar. Okay, So this is the euro dollar. So for the euro dollar, yesterday we do have a bearish bias over here for the euro dollar. So the first support level has been made yesterday at 1.0870 before staging another bounce. So it already tested one time, two time, three time, this 1.0870, and where it bounces, right? It bounces right exactly at the lower limit of this minor ascending channel that is still in play since the low of 26th of June. And during the bounce over here, when it start to bounce, okay, the RSI has starts to continue shape a series of higher low, right? Over here. Over here, we see similar low, right? Okay, similar low, but RSI higher low. So what it means that at this juncture, there could be some form of positive momentum creeping back into the euro dollar market. So given this latest positive intraday or short-term development that's being seen or being played out on the hourly RSI, the conviction for me to have a bearish intraday bearish bias for today has been greatly reduced because of this positive element. So we got to be dynamic, especially if we look at price action perspective. So with this positive that dynamic that has taken shape on the euro dollar, I will flip to a short-term intraday bullish bias for today on the euro dollar using 1.0870 as my key short-term pivotal support level. First near-term resistance level to watch will be at 1.0920. A break above 1.0920 may expose 1.0960 / 1.0980. We also confirms with this gray line here, which is the major ascending this major symmetrical trend line resistance of the symmetrical triangle configuration that has been in place since the high of 18 July 2023. All right, this gray line here. So this is so overall, right, since 18 July 2023, the euro dollar has been trading in the major symmetrical triangle range configuration, and that 1.0960, 1.0980 is confluencing with the major symmetrical triangle range resistance as well, thus making it like a pretty much significant magnetic level to watch out for. Only a breakdown of the hourly close below 1.0870 will invalidate today's intraday bullish bias to see another round of minor corrective decline, to see further near-term weakness, to expose the next near-term support level at 1.0840. Below it sees 1.0805, which being confluenced by the three moving averages, the 50, the 20, and the orange line, which is the 200-day moving average. Okay, so that's for the euro dollar, and no change for the sterling dollar. Is going to trade sideways, and given that there is some form of bullish we call it momentum that's being seen on the other European currency pair, which is the euro dollar, we will still stick to a neutrality stance on the sterling dollar itself. That means despite it trading sideways, it's still holding above the 1.29 short-term range support level that I highlighted yesterday, and this 1.29 figure is very important level as well, because it's now the pullback support of this former long-term circular descending trend line. Previously was from the swing high of 2nd of June 2014, that's close to about 10 years back. It has been broken out on the 12th of July and now turns into a pullback support level. So no change, neutral between 1.2990 and 1.29 figure for today on the sterling dollar. Okay, now moving on will be the dollar Asia Pacific pair. Over here means the dollar against the Asia Pacific currency. So starting with the Aussie dollar first. So for the Aussie dollar, yesterday we attempt to play a minor bounce, holding above the 66.70 at the 50-day moving average. Unfortunately, the bounce didn't take shape, and the price actually immediately just punched through it. So what I could see over here is that yesterday pushed down in the price section. We very quickly we go to the daily time frame chart, has indicated to us, right, that previous move here, okay, the previous breakout of the 66.90 level, which is also this medium-term symmetrical triangle range resistance, previously from 3rd of February 2023 high. This bunch of movement here is considered as a failure bullish breakout. So after a few failure bullish breakout, we tend to see a slew of profit taking place. That means a lot of players got stop out over here, short-term players. So we see a very steep unwinding of initially long position that is being we call it open at the break of that 66.90 level. So this is like a inverse reflexive price action movement because of the reintegration below the 66.90 level. That means indicating to us that the move from 4th of July all the way up to 15th of July is a failure bullish breakout. And yesterday price action also closed below the 50-day moving average as well, indicating further negative we call it momentum that is now taking shape on the Aussie dollar. Okay, so with that over here, on the intraday basis time frame for today, we will flip to a bearish bias using the 66.70 level, which is the 50-day moving average now acting as a resistance. So this will be my short-term pivotal resistance level. Next support level to watch will be at 66.20 level. A breakdown below 66.20 level will may see further potential weakness to expose the next support level at 65.90. So this 65.90 is the minor swing low of 11th of June and 17th of June, and so confluencing very closely with the key 200-day moving average as well. Only an hourly breakout and hourly close above 66.70 will negate this short-term intraday bearish bias to see a much more kind of a minor counter trend rebound scenario taking shape to retest this 67 figure 67.10 level, which also correspond to this 20-day moving average that is acting as a resistance level as well. All right, so that's for the Aussie dollar. Now the dollar yen. So dollar yen yesterday, because sideways intraday is kind of mixed over here, and right now we were neutral yesterday between 157.70 and 156.70. So for sure now price action have already broken below 156.70, and while they broke down below it start to trace a series of lower high, indicating to us that the lack of upside pressure of breaking above the 157.70 level. All right, so with that we will flip now back to a bearish bias below 157.70. So this 157.70 will be my short-term pivotal resistance level, which is also confluence closely with the 50-day moving average. 50-day moving average I think as a resistance level around this area as well. So first near-term support level to watch will be the 156 figure level. Below it may expose further weakness towards the next near-term support zone at 155.10/154.75, which is the minor swing low area of 4th of June and 7th of June, and as well also confluence with the Fibo extension level on the downside, the one-time Fibo extension level. All right, that I drew from here. Only an hourly close with a break up above 157.70 short-term pivotal resistance level will invalidate today's intraday bearish bias on the dollar yen, and from there we may see a potential squeeze up to the next near-term resistance at 158.80 and potentially even 159.45/90, which confluence with the 20-day moving average and as a resistance, and we do the Fibo retracement of this current down move from the high of to the low of 18th of July, the 159.45, 159.90 also confluence with the golden ratio at 61.8%. All right, so that's for the dollar yen, which eventually sum up the intraday technical outlook on the major FX pair. So now moving on will be the short-term intraday technical outlook on the major stock indices, starting with the Asia Pacific Index, which is one of them, the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index yesterday we flipped to a short-term intraday bullish bias. The first resistance level to watch will be that the 17820 17,870 level, which also confluence with the 20-day moving average acting as a resistance. And early today Asia session, we do see a price action, negative price action right below this resistance level. So given this negative price reaction at this resistance level, potentially in the near term or the intraday basis, we may start to see further weakness going forward on the Hong Kong 33 or the Hang Seng Index, purely based on a price action perspective right now. So using 17,820/17,870 as my short-term pivotal resistance for today, we'll flip to a short-term intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. First near-term resistance support level to watch 17,470. A breakdown below it may potentially see a retest of yesterday's swing low at 17,320. And bear in mind, the key medium-term pivotal support level to watch will be at this 200-day moving average at 17,200 / 17,110 level. All right, only an hourly close back above the 17,870 level will invalidate today's intraday bearish bias to see the continuation of that short-term minor rebound scenario unfolding for the next near-term resistance to come in at 18,225 next, which also correspond closely to the 50-day moving average, I think, as a resistance as well right now. So that's for the Hong Kong 33 and or the Hang Seng Index. Moving on will be the Japan 225. So Japan 225, So Japan 225 yesterday, the first resistance level to watch will be at 40,050. We do have a bullish bias yesterday because price action continues to be holding on at the 50-day moving average, but there is no positive breakthrough above the 40,050 level, and price action continues to actually shape that bearish reaction. So with that, given the lack and also the RSI, if you look at the RSI right now, if I were to connect, give me a minute now. Okay, it seems to be breaking below this parallel ascending trend line as well. Okay, parallel ascending trend line, that means the breakdown below this support level, parallel ascending support level. So indicating that there is lack of upside momentum follow through to do a breakout above 40,050 level, which is our first resistance yesterday. So given this lack of upside momentum creeping into the this Nikkei 225 index or the Japan 225 index, not so much conviction to actually maintain that short-term intraday bullish bias. So with that, I will actually flip to a neutrality stance for today for the Nikkei 225, given its latest price action development that is taking shape right now. So neutral between this 39,350 and 40,050 level. All right, so but however, if we start to see a breakdown below 39,350, then I got to respect the bearish price action, which we may start to see the continuation of this minor corrective decline to expose the next near-term support at 38,750, and below it sees the swing low area of 30th of May and 15th of June, 14th of June, pardon me, at 37,980. Okay, so for now, neutral between 40,050 and 39,350 first, due to the lack of upside momentum that is taking shape on the Japan 225 or the Nikkei 225 market. Now, moving on will be the German 30 or the German DAX, which is one of the major European stock indices. So yesterday we do have a bullish bias. Why? Because the prior day weak price action movement has really hit the lower limit of this expanding wedge configuration, the one that I draw in purple line, okay, since the low of since 14th of June. All right, so it hit exactly at the lower limit of the wedge before shaping that bounce and hitting off our resistance level at 18,520. And right now the hourly RSI has also hovered at the overbought region. So potentially in the short term, we may see a bit of minor pullback taking shape over here. So we do still have a bit of room more to go before hitting the upper limit of the expanding wedge, but bearing in mind that price action don't go vertical up or vertical down, they actually oscillate within a phase configuration of that. So now it's actually oscillating within an expanding wedge configuration. So given the RSI overbought condition, and right now is doing the Asia session, now is exiting for the overbought level, potentially there could be a minor pullback first before shaping another potential minor uplift within this expanding wedge configuration that is still playing out in the German 30 or the German DAX. So for the minor, we call it pullback level to watch out for, there are two levels to watch. First level will be the 18,395, followed by the golden ratio, which is the 61.8% Fibo retracement at 18,290. So I'll be using today as a Titan key short-term pivotal support, 18,290 for that potential minor pullback to take place first. So as long as this pullback didn't surpass below 18,290 for today, potentially there could be another round of bullish movement taking shape thereafter. First resistance to watch for sure will be at 18,520, then thereafter followed by 18,630 from an intraday perspective. But however, if we start to see a breakdown below 18,290, then today's intraday bullish bias will be invalidated to see a retest at 18,150, which is the lower limit of this expanding wedge configuration, which is the expanding wedge support level. Okay, so that sum up for the German 30. Now let us have a quick look at the major US stock indices, which is the US Wall Street 30 starting first, which is Dow Jones Industrial Average. So no change. The US Wall Street 30 yesterday kind of trade sideways after intending to bounce slightly off the 39,890 short-term pivotal support level, which is so correspond to the rising 20-day moving average. So still using 39,890 as my short-term pivotal support, maintain that intraday bullish bias on the US Wall Street 30, i.e. the Dow Jones Industrial Average. Near-term resistance level to watch on the intraday basis will be at 40,670. Above it exposes 41,050. All right, only an hourly close below 39,890. That means the price breakdown below 39,890 will invalidate today's bullish bias on the US Wall Street 30 to see the extension of this minor corrective decline towards the next near-term support at 39,620 and potentially even 39,300, which confluence with the rising 50-day moving average. All right, so right now let's just focus on the Nasdaq 100. But before we talk about Nasdaq 100, let's have a quick look at Nvidia, given that Nvidia has a significant weightage in the Nasdaq 100. So any potential movement on Nvidia could also shape the movement of the Nasdaq 100 as well. So let me load the chart of Nvidia. Okay. Okay, it's a bit slow right now. Okay, yeah, this Nvidia. Okay, so if you look at Nvidia itself over here, yesterday the price action managed to actually shape a bounce right at the support level, which is we highlighted earlier on at this 118.32. We also correspond to the rising 50-day moving average as well. And yesterday bounce came up with a high volume bounce, greater than the previous day volume. You could see this volume over here. So net overall is still bouncing off a significant support level with high volume, which is actually positive. And what we could see, if today we're going to see a positive price action follow through, okay, to actually cover this gap here, this gap down here initially at 125.28, which is also the 20-day moving average. So if we have a daily close above this level, it actually add more credence to the continuation of this medium-term uptrend phase of Nvidia, and potentially that could also translate to a positive feedback loop on the Nasdaq 100 as well. Okay, so now back to the Nasdaq 100 technical analysis chart on the intraday basis. So we still looking at the 19,520, which actually it bounced off and continue its positive price action follow through yesterday. Hit the first resistance yesterday before trading at a minor pullback. Okay, so no change, still using that 19,520 short-term pivotal support level, which also correspond to the 50-day moving average. I think as a support will be my short-term pivotal support for today. Still maintain that intraday bullish bias on the Nasdaq 100. First resistance 20,060, followed by 20,210 next. Only a breakdown of the hourly close below 19,520 will invalidate today's intraday bullish bias on the Nasdaq 100 to see it extending the minor corrective decline towards the next support level 19,155 and even 18,950 next on the intraday basis. So that sum up the intraday technical outlook on the major stock indices. Now let us focus on the commodities market right now, starting with this gold first over here. So gold XAU/USD managed to do a bit of this whipsaw at the 2,393 short-term pivotal support level, which also correspond to the 20-day moving average, I think, as a support level as well. And after shipping that kind of whipsaw level around the 2,393 short-term pivotal support that we have yesterday, the hourly RSI very interestingly starts to shape a bullish divergence as well. So indicating that yesterday's low, which is this level here at 2,383, might be the inflection level or a potential bullish reversal level for the price action of gold, right? XAU/USD, at least on the intraday basis. So with that, right, I will have a bit of excess for today. Okay, so this is the excess level. Oops, it's hang over here. Let me do it again. Okay, so let's me put it in green. Okay, 2383, settings. Okay, so /383. Okay, so a bit of access /383, 2393 /383, short-term pivotal support for today. First resistance level to watch out for will be this level here. On the intraday basis, will be at 2004.11. Above 2004.11 sees 2004.31 next. Okay, only an hourly close below 2383, then this intraday bullish bias viewpoint will be invalidated to see the continuation of this corrective decline scenario unfolding, exposing the next near-term support at 2368 and potentially even 2337 next on Go XAU /USD. Now, lastly will be the WTI crude oil over here, West Texas oil. So West Texas oil, we continue to actually bounce at the 79.20 level. So a bit of whipsaw here as well, which is the 200-day moving average. It managed to actually help at this level. So what I'm going to do over here is that I have a bit of excess right now using yesterday's low as well over here. Okay, let me draw that line. Oops. Okay, it's a bit slower. Sorry about that. Okay, why it's not picking up the line? Okay, no more. Okay, so what I'm going to do is that maybe I don't draw the line. I just highlight the low. So yesterday low was 78.72. So what I'm going to do now is I will, slash it. Okay, 78.72. Okay, so the 78.72 is yesterday's swing low over here, 78.72. So that will be my access for the short-term pivotal support for today, which it bounces off right exactly at the 200-day moving average. So we got to respect there's some form of indeed a support by the 200-day moving average that managed to store the prior day weakness on the West Texas crude oil. So using 79.20 / access 78.72, still maintain that short-term intraday bullish bias for that minor bounce scenario to actually potentially play out. First resistance level to watch in the near term, 80.30. Above it sees 81.20 next on an intraday basis. But however, if we start to see an hourly close, a breakdown below the 200-day moving average, which is 78.72, then this intraday bullish bias scenario will be invalidated to expose the next near-term support level at 77.80, and below 77.80 sees 76.30 next. All right, so that's for the technical outlook, intraday technical outlook on the West Texas crude oil. So before we go, let's have a quick look at the economic calendar. What are the events on the highlight for you guys to actually have a look or take notice of in today's trading session. So on Tuesday itself, it's also a rather quiet day in the European session. What we have over here is at yeah, it's pretty much quiet. So the one that is the key data to come out, that's more for Eurozone at 10 p.m. Singapore time will be the consumer confidence flash index for the Eurozone that will come in July, for the month of July, pardon me, out at 10 p.m. Singapore time. And we do have some home sales US data, existing home sales US data for June coming at the same time at 10 p.m. as well. But the most important US related data is more related to the US major stock indices, because at the close, after the close of the US session today, that means after 4 a.m. Singapore time today, we do have the release of two key mega cap stocks in the US, which is Tesla and as well as Google Alphabet. So let me share with you all, where is it over here? Yeah, over here, Alphabet and Tesla. All right, so over here, especially Tesla market is expecting a low ball consensus EPS at 0.61 EPS per share versus 1 year ago at 0.91. And Alphabet continues to be rather positive in terms of the consensus for their EPS for this for the previous quarter at 1.83 EPS versus a year ago at 1.44. Okay, these are the two data to look out for. So with that, let us now sum up today's Daily Dose of Market Insight. So that's the end for today. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.